From a high of 1,513 rupees per share in mid-February, Shriram Transport Finance has climbed down to around 1,380 rupees. So, if anyone had bought the stock in November and had sold it in mid-February, he or she would have got a return of 119%. So, since the stock has consolidated a bit, is it a good time to pick up the Shriram Transport Finance Company Limited, one of India's largest NBFCs, or do we wait till it consolidates further? So let's know all about Shriram Transport Finance Company. The company is a large deposit-taking NBFC and a strong survivor post the mayhem ushered in first by IL&FS crisis and then the pandemic. The company is mainly into funding in the used vehicles market. It has a diversified funding base and continue to garner funds from its diverse sources, including foreign borrowings and banks, where on lending to NBFC is now considered a part of priority sector exposure. It is also stepping up efforts to have a larger retail deposit base. So there's hardly any possibility of a structural liquidity challenge. Financial performance. Though business loans on year-on-year basis dropped by 16% in Q3 FY21, the used vehicle market had done relatively better in the midst of the pandemic, and growth certainly looked strong, wherein disbursement grew by 8.6%. It was largely driven by 10.8% pickup in used vehicles. Overall asset under management grew by 5.5% year-on-year. Profit after tax is expected to decline from 25,019 crore rupees in FY20 to 24,444 crore rupees in FY21. The recovery is still on, as the management indicated that in the fourth quarter, demand for heavy commercial vehicles has also revived after remaining weak for long. Overall growth has been extremely positive in Q4, with demand for new vehicles picking up as well, and achieving mid-single digit of approximately 6% assets under management growth in FY21 is not at all asked. With the ease of liquidity conditions and much easier funding options for established large NBFCs, the company has seen an improvement in its margin. The buffer liquidity that is deliberately maintaining in the light of the uncertainty caused by the pandemic is impacting interest margin to the tune of 30 basis points. It is confident of maintaining 7% level of net interest margin. Moreover, Shriram Transport Finance has a comfortable capital adequacy ratio at 23.61%. Asset quality. 84% of Shriram's asset under management comes from borrowers being engaged in livelihood activities in semi-urban and rural areas. With the resumption of activities post the lockdown, the collection efficiency has improved dramatically to 104% of the demand in the month of December and continues to remain strong in Q4 as well. Consequently, pro forma gross NPA declined by 15 basis points sequentially to 7.11% and net NPA by 20 basis points to 4.31%, with a stage 3 provision cover stands at 41%. Restructuring proposals of 2,267 crore rupees is well below the earlier guidance of close to 2,800 crore rupees, and the company has been beefing up its provision in the past few quarters with additional provisioning for COVID-related stress at 2,507 crore rupees. It expects the credit cost in FY21 to be in the vicinity of 2.5%, with the management looking to complete normalization of credit cost, which is at 2% level from FY22 onwards. Future outlook. The scrappage policy is going to provide the much needed boost and put the company on a fast track, as the owners of older used vehicles who would have to scrap the vehicles are likely to trade the scrappage certificate and themselves opt for a used vehicle of shorter vintage. As a result, the average age of the vehicle funded would come down from the current 6 to 7 years to 5 to 6 years. Management is quite confident of achieving double-digit growth in the coming few years on the back of economic revival, focused attention of the government on reviving infrastructure, and improving rural income. But one should remember that there is always the looming risk of the merger with group companies that would dilute the unique characteristics of its expertise in the used vehicle section. Overall, we feel as the earnings gain traction, the stock can gradually re-rate and investors should use the current weak phase to gradually accumulate the stock.